Assalamu alaikum. Good evening to all of our viewers and learners. As part of collaborative assignment, our group has taken immense pleasure in utilizing this opportunity to introduce about a very important concept, economic value added, EVA. We thank Dr. Lat Hadidi for giving us this platform to present our interested topic in an easiest and effective way. Generally speaking, firms measure their business in terms of profit and loss. If their revenue is more than expense, they define it as profit. And if expense is more than revenue, they are in loss. It's a very simple concept, but this limit knowledge sometimes lead to wrong business decisions. And so, EVA takes a further step ahead to avoid such wrong decisions. So to speak about EVA, I would like to simplify by considering two projects. Let's say Project A and Project B. If you have a capital to invest in either of two projects, which project you will choose? Let's say both require equal investment. Then of course you would prefer to invest in the project that gives you more return. For instance, Project B gives more return, you would choose Project B. Therefore, EVA looks into future investment and tells us where to invest besides just profit and loss. EVA is also referred as economic profit. It's a useful tool for choosing the most promising financial investments. Like previously we have compared Project A and Project B. We found Project B was more financially profitable. It also acts as an estimator for companies through economic value creation. EVA calculation is simple and reflects company's performance. Negative EVA indicates destructive, while positive EVA indicates constructive. As we have seen in our example, both projects had more revenue than their capital, therefore both were profitable. But EVA of Project A is negative, while EVA of Project B is positive, due to the fact that Project B has more revenue than Project A. Here we understand that EVA compares both projects' profit. All we have discussed till now was a simple concept of economic value added. Now let's look into its professional term with respect to capital cost and profit. Economic value added is a measure of company's financial performance based on the residual wealth calculated by deducting cost of capital from its operating profit. We will understand this definition by going through an example to calculate EVA, which is coming up in the following slides. To calculate EVA, we require company income statement and company balance sheet. Income statement of a company. This is an example of company income statement. As we see that there is a net sales of 2,600, the cost of goods sold is 1,400, SG&A expenses as 400, depreciation as 150, and other operating expenses as 100. So if we subtract all these expenses from the net sales, we get 550 as an operating income. Then there is an expenses interest, the interest charge on expenses, that is 200 in this example. So therefore we have income before tax as 550 minus 200 equal to 350. Now this is before tax, but when we have a tax, Like in this example of 25%. So this 25% is charged on the operating income. 550 into 25%, we get 140. So therefore 550 minus 200 minus 140, we get 210 as net profit after tax. This is a very simple calculation because here just we are subtracting sales minus the expenses, and then also we are considering the tax of 25%. The second thing we require is balance sheet. This is a company balance sheet. As we see on our left side, we have total assets, and on our right side as total liabilities. Now let us look into EVA calculation steps. First step, calculate net operating profit after tax, no PAT. Second step, identify company's capital. Third step, determine a reasonable capital cost rate, CCR, which is a very crucial step in this EVA method. Then fourth step, calculate company's economic value added, EVA, which is a very simple formula. NOPAT, net operating profit after tax, equals net profit after tax plus interest expenses. So when calculating NOPAT, we deduct all the expenses from sales to get operating income as discussed in income statement before. Note, here we don't consider interest expenses. So when 25% tax on operating income is deducted, we get NOPAT, that is net operating profit after tax, which is also equal to net profit after tax plus interest expenses. Like in income statement, we got net profit after tax as 210, and the interest expense was 200. When we add 210 plus 200, we get 410. Step number 2, calculation of capital. We have already discussed in the balance sheet slide regarding the calculation steps for the company's capital. The total liabilities minus accounts payable and accrued expenses. In this very example, we have total liabilities as 2,350 and the accounts payable as 100 and accrued expenses as 250. So thereby we get a capital of 2,000. Step number 3, to calculate capital cost rate, CCR. Here we require 4 things: percentage of equity, percentage of markup, percentage of debt, and percentage of interest. I repeat, percentage of equity, percentage of markup, percentage of debt, and percentage of interest. Yes, every company has its own markup or minimum return. Less than this is not acceptable. In this example, company or owner's return is 13%. Now to find the percentage of equity the company has, we need to look into balance sheet. On the right side column under liabilities, the total equity capital is given as 940 out of 2350 as total liabilities. Therefore, the percentage of equity equals 940 by 2350, that is 40%. And the rest 60% is debt. In this example, the interest charge on this debt is 8%. So, capital cost rate equals percentage of equity multiplied by company return plus percentage of debt multiplied by interest. That is 40% into 13% plus 60% into 8% equals 10%. Finally, step number 4. We now calculate the company EVA. EVA equals NOPAT minus capital multiplied by cost capital rate. Here, when we analyze this formula, we can see that more than NOPAT, more is the EVA, whereas more is the capital, less is the EVA. Similarly, more the cost capital rate, less is the EVA. And cost capital rate depends on percentage of equity and company's return. So when we have more percentage of equity or more is the company's return, less is the EVA. In conclusion, EVA does not see only profit. It also considers the capital invested in the project and company's markup. If the project requires more capital or the company has high markup, then profit should be relatively more to keep the EVA more positive among other projects' EVA. In this example, the company created a positive EVA of 210. Now let us see how the company can maximize its EVA. The company must look for the projects with low capital investment and more returns, hence EVA will be more positive. Number 1. Try to improve returns with no or with only minimal capital investments. Number 2. Invest new capital only in projects, equipment, machines able to cover capital cost while avoiding investments with lower returns. Number 3. Identify where capital employment can be reduced. Number 4. Identify where the returns are below the capital cost. Divest those investments when improvements in returns are not feasible. Hence, EVA is verified. Thank you.